Group Health Insurance Explained. This video was written and produced by Howard Deal, owner of the General Agency. This video covers many aspects of group health insurance, and what every employer should know. Group health insurance defined. Group health insurance provides coverage to a group of members. Commonly, group insurance is used for employer groups. However, it can be used for associations or organizations. Group contracts are issued to the entity, and the employees or members are the subscribers. Group insurance is generally more affordable for the members as the risk is distributed across the group. When contracts are issued to an employer group, employers are generally required to contribute to the cost of the members. Keep in mind, employers are not required to contribute to the members' dependents. And we will cover this in more detail later in this video. Group size. Small group is considered 2 to 50 employees. Mid-market is considered 51 to 100 employees. And large group is considered 101 or more employees. Some carriers will allow a husband and wife group to count as 2 employees. And others will allow a group of 1 insured, if the group has at least 1 other employee on payroll. Underwriting guidelines differ between each insurance company. For more information on a specific carrier, check with your broker. Requirements for group health insurance. Only full-time employees, or 1099 employees working 30 or more hours per week are eligible. In most cases, insurance companies require a minimum of 2 enrolled employees. However, some allow 1 enrolled employee as long as there is 1 other employee on payroll, full or part-time. Employer contribution. Group health plans require an employer to make contributions to the employee-only rate. These contributions are set by each individual insurance company's guidelines. Generally, employer contribution requirements are 50% to 70% of the employee-only rate. Participation requirements are guidelines set by each insurance company. In most cases, the insurance company requires a minimum of 50% participation to qualify for group health insurance. Fun fact: the term underwriting is believed to have been started by the Lloyd's of London Insurance Company. Containers shipped by sea would list the contents, and a representative of the insurance company would write the company name and premium below the contents. As shipwrecks were common, the owner of the container would pay a premium to ensure the contents would arrive safely. Hence the term underwriter was born. Today, underwriters assess risk for potential losses. In group health insurance, underwriters assess risk based on a group's age, gender, geographic location, industry type, and existing medical conditions. Fully insured. Fully insured group health plans with 1 to 50 employees have no medical underwriting questions due to the passage of the Affordable Care Act. Groups of 51 or more employees, or mid-market groups, may be required to submit a medical loss ratio report from a prior carrier. Level-funded and self-funded plans, for groups of 2 to 50 employees, require each employee to complete a detailed medical questionnaire. In some cases, larger groups within the 2 to 50 employee range may only require simplified medical questionnaires. For more details, contact an experienced group health insurance broker, or call us at the General Agency. Plan types. There are several commonly purchased group health plans on the market today. They are fully insured, self-funded, level-funded, HMO, PPO, EPO, and reference-based pricing. Fully insured. Fully insured group health plans have been the most common policy type for small groups in the past 30 years. Insurance companies offering these plans assume all the risk from an employer. The employer pays a monthly premium on, in most cases, an annual contract, and the insurance company pays the claims. These contracts are unilateral, or one-sided, which means the employer can cancel the coverage at any time with no runoff responsibilities. Self-funded plans. Self-funded insurance plans are generally purchased by large employer groups. With these plans, the employer assumes the claims risk with the option of purchasing stop-loss coverage. The optional stop-loss coverage covers catastrophic claims, which can bankrupt a company. Some major companies purchase administrative services only plans, or ASO. When an employer group purchases an administrative service only plan, they assume all claims risk, and are only paying for administrative services from the insurance company, which generally only includes contract preparation, ID cards, network access, and claims processing. Level funded. Level funded policies are written as self-funded contracts. These policies have stop-loss coverage, which is assessed based on the group size. The employer is responsible for the claims prior to the stop-loss coverage, covering the excess losses. In other words, the group itself has a large deductible on the group's policy. This large deductible is divided by the length of the contract. For example, if an employer has a $12,000 aggregate deductible on a 12-month contract, the $12,000 is divided by 12 and the employer pays $1,000 a month, which is built into the overall premium. If the group's claims are less than $12,000 during the contract year, the employer receives a refund for the unused claims. For more information on this, subscribe to our channel and see our video on level funded plans. HMO plans. Health Maintenance Organization plans are in-network only plans. Members must stay within the provider network, and networks are determined by geographic area. HMOs can cover members worldwide for accidents and emergencies, but not for routine care. Most HMO plans also require the member to use a primary care provider, or gatekeeper, and all care must be directed through the member's primary care provider. PPO plans. PPO plans allow members to use in-network and out-of-network providers with no gatekeeper. Members have co-payments for certain services such as doctor office visits and specialist visits. Members are also subject to deductibles for major medical care. And most PPO plans have separate deductibles and co-insurance for non-network providers. Although PPOs allow members the flexibility to use non-network providers, coverage is generally reduced, and members are subject to usual, reasonable, and customary charges, or URC. For more information on URC, we will provide a link in the description for our video on usual, reasonable, and customary. EPO plans. EPO, or Exclusive Provider Organization plans, are similar to an HMO, but with a much smaller network. These plans can leverage favorable contracts with providers, which in turn can result in lower rates. EPOs are generally in-network only plans, and may only cover a small geographic area for routine and scheduled services. Like an HMO, an EPO can cover its members worldwide for accidents and emergencies. High deductible health plans. High deductible health plans, or HDHP plans, are often referred to as an HSA plan. However, an HSA is a bank account, whereas the HDHP is a health plan. These high deductible health plans are designed to use in conjunction with an HSA bank account. High deductible health plans require the member to satisfy a deductible before any benefits are paid, except for wellness benefits. There are no co-payments or co-insurance until the deductible is met. Most high deductible health plans are written as a PPO plan, which allows members to use both in-network and out-of-network providers. High deductible health plans have favorable tax advantages, as the deductibles and co-insurance are tax-free to the member. Contributions to an HSA bank account by the employer are also tax-free. Reference-based pricing plans, or RBP plans, are similar to a traditional indemnity plan as it has no network requirements. Policies are written as a level-funded or self-funded policy, and payments to the providers are based off a percentage of the Medicare fee schedule. Members can access any doctor or hospital with no reduction in benefits. However, usual, reasonable, and customary charges may apply. Reference-based pricing plans can be substantially less expensive than most group health plans. However, educating the members is vital. Advantages. The primary advantage for an employer to offer a group health plan is to attract and retain quality employees. Employees participating in a group health plan can have their premiums paid with pre-tax dollars. Employers offering a group health plan also reduce their payroll expense and receive additional tax advantages. In addition, members that would otherwise have difficulty purchasing an individual plan can participate in a high-quality group health plan. Group health insurance cost. The cost of a group health plan is deceptively affordable. Typically, employers only pay a percentage of the employee-only rate. The percentage the employee pays and the cost to add their dependents comes out of payroll. In addition, the employer does not match payroll taxes on the employee's contributions and receives an additional tax credit for offering a benefit plan. For more information, please go to the description to watch our video on how much benefits really cost. COBRA versus state continuation. COBRA stands for Consolidated Omnibus Budget Reconciliation Act, which was enacted in 1985. Employer groups who have had 20 or more full-time employees, for more than 50% of the preceding calendar year, are subject to COBRA. This bill allows employees who were insured on a group health plan, the ability to continue coverage on the company health plan for 18 months. Dependents who were covered on a group health plan can stay on COBRA for 36 months. COBRA legislation can be complicated. Employers, who are subject to COBRA, should consider contacting a COBRA administration company. State continuation is for groups of 2 to 19. Each state can have different rules regarding state continuation. In most cases, state continuation allows employees to continue coverage for 6 to 9 months. For more information on state continuation in your state, contact a local health insurance broker. Group health insurance companies. GUCA is an industry term for the more well-known health insurance companies. They are Blue Cross and Blue Shield, United Healthcare, Cigna, and Aetna. These companies insure approximately 50% of the employees in the United States. One company not mentioned in the well-known companies category is Humana. This is most likely an oversight as it did not fit the acronym, but bears mentioning. Some of the less known companies, such as Allied National, National General, Trustmark, and others, can be a great fit for your company. Many of these companies can be an excellent fit as they must compete for market share. Quoting options. What to consider when requesting a quote. Online. Some websites give you the ability to submit your company data and receive an instant quote. It is important to note, the quote you receive are commonly fully insured and are table rated. Since the Affordable Care Act has removed medical underwriting from the quoting process, the rates are set. Also common are lead generation sites. These sites gather information and sell it to agents and brokers. We recommend finding a knowledgeable broker that understands your company's needs. Submitting a census to a broker. Submitting a census directly to a broker is recommended. A census form will allow a broker to shop multiple insurance companies, both well-known and lesser known. Working with the broker also allows for detailed underwriting and plan options. Another consideration is agency size. Smaller agencies and independent brokers get to know you and your business as your needs change. Additionally, your business may represent a larger segment of a smaller agency's book of business, giving you a more hands-on approach. We thank you for taking the time to watch this video, and hope you found it informative. Remember to hit the like button, and subscribe to our channel for more cost-saving and instructional videos on employee benefit coverages and products. And have a great day.